global financial system is bloated with some 65 trillion in hidden off-balance sheet dollar debts. A recent report from Bank of International Settlement warns us. And here is that report: dollar debt in FX swaps and forwards, huge, missing and growing. Now let's quickly go through some of the key points of this report. It was published on 5th of December this year. And FX swaps, forwards and currency swaps create forward dollar payment obligations that do not appear on balance sheets and are missing in standard debt statistics. Non-banks outside the United States owe us as much as 25 trillion in such missing debt, up from 17 trillion in 2016. Non-US banks owe upwards of 35 trillion. Much of this debt is very short-term, and the resulting rollover needs make for dollar funding squeeze. Policy response to such squeezes includes central bank swap lines that are set in a fog with little information about the geographic distribution of this missing debt. And on the numbers, here are the actual numbers. For non-banks outside the United States, dollar obligation from FX swaps, forwards and currency swaps have grown fast, reaching to 26 trillion or double their on-balance sheet dollar debt. In mid-2022, non-US banks with direct access to Federal Reserve credit only in their US operations owed an estimated 39 trillion of dollars from FX swaps, forwards and currency swaps. So these 39 plus 26, 65 trillion of total off-balance sheet debt. So, and they're further saying these off-balance sheet dollar debt poses particular policy challenges because standard debt statistics miss it. The lack of direct information makes it harder for policymakers to anticipate the scale and geography of dollar rollover needs. Thus, in times of crisis, policies to restore the smooth flow of short-term dollars in the financial systems are set in a fog. And now let's see some other publications what they are saying. The Business Insider are reporting this. There's an 80 trillion blind spot in the financial systems that could spell trouble for markets as debts held off balance sheet grow at a rapid pace. And here is a number. BIS said there's more than 65 trillion in currency-related debts that has little transparency and growing quickly. This one from Washington Post, it's a 65 trillion in debt you cannot find. That will get you. And this is interesting. 1 second. $65 trillion is not a big number. It's a huge, barely comprehensible number. It's more than 2.5 times the size of the entire US Treasury market, the world's biggest. It's 14% of the value of all financial assets globally, according to a tally from Bank of International Settlement. So these 65 trillion of debt we are talking about isn't a set of straightforward loans or bonds. It's the repayment obligations on foreign currency swaps and forwards. Now, over the recent past, persistent inflation and a return to quasi-normal monetary policy have exposed a growing list of financial vulnerabilities, from bad hedging at British pension funds to reckless management in a major cryptocurrency exchange, that is FTX. Now comes this warning of another danger, and that could dwarf the others. And this appears to have been part of the panic that struck British pension funds in September this year, as a sharp decline in the pound led to margin calls on forex hedges on top of the collateral calls pension managers faced related to their interest rate derivatives. This takes the form of foreign exchange swaps that entail a currency trade made today with a commitment to reverse it in the future. Those future commitments constitute a form of debt, but they often are not recognized as such by accounting rules for banks or other companies. These levels of off-balance sheet forex swap debt dwarfs the 28 trillion in on-balance sheet swap liabilities that BIS tabulate. So the BIS notes that this form of off-balance sheet obligation has exploded in recent years, rising from 37 trillion in off-balance sheet obligations that was there on the eve of 2008 financial crisis, and now that has grown to 65 trillion. And a variety of factors explain the increase, most tracing to the consequences of 15 years of unnaturally low interest rates around the world. So asset managers such as pension funds and insurers in developing economies have expanded investment in dollar-denominated assets as part of their search for yield amid lower interest rate globally. These asset managers then must enter into foreign exchange swaps to hedge currency mismatches between their assets and liabilities. These swaps are a form of liability that entail liquidity and counterparty risk but are not recorded as credit or debt on the balance sheet. And that's exactly how financial risk is born. This off-balance sheet debt poses several threats to financial stability. No one knows for sure where all of these debt is lurking, and many events could trigger a cascading crisis. One source of vulnerability is exchange rate volatility. Sudden swings up or down in the value of dollar relative to other currencies can trigger short-term collateral calls and liquidity. Interest rate risk is another danger. One reason for forex swap market grew so fast in recent years is that because of a steeper US yield curve compared to other major economies. What that meant is relatively lower short-term interest rates and relatively higher long-term rates essentially allowed banks and other firms to borrow short because that is super cheap and lend long because that will bring more interest income for the lenders. And now as the US yield curve has inverted, investors must roll over their short-term swaps agreement at much higher rates. Meanwhile, dollar-denominated foreign exchange swap dates are overwhelmingly held outside the US. American banks and companies tend to be creditors in these arrangements, and this exacerbates the liquidity crisis. The Federal Reserve is not able to act as a lender of last resort to foreign banks or other institutions that face dollar liquidity squeeze arising from their swap positions. This leaves foreign banks dependent on their local central bank's currency swap arrangement with the Fed to provide dollar liquidity. So we can now only hope that these swap positions unwind smoothly as central banks return to less abnormal monetary policy. But the BIS report on these hidden debts serves as a warning, a huge warning indeed for the future. That pretty much wraps up this video. If you liked it, do smash the like button, and also don't forget to subscribe. See you in the next one.